It's like we're in a marathon and we're at almost the halfway point for 2024. Is there still uncertainty in markets after a surprising uplift this year? What are the main drivers for the markets right now and really for the Fed decision that's coming up this month? And what does the fixed income performance look like for the rest of the year? We're going to break it all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for joining us today. Leslie Falconio is back with me as my guest to break down the latest on everything going on in the fixed income market. So, Leslie, good to have you. Good to see you.
Thank you, too.
Yeah. So, Leslie, listen, let's get right to the chase here. And every time you come by, we talk right into what's going on. What's really been the driver of fixed income performance so far this year? And maybe the part two of that is, what does that tell us about what we might expect in the second half of the year?
Yeah, well, I mean, there's no question. The market has gone through, the first half of this year and the latter part of 2023, a continuous reassess and repricing of the Fed fund projection. So there's a very large correlation between what the 10-year does and the future Fed fund path, right? So every time the market gets a little hawkish, interest rates go up. When they get a little bit dovish, interest rates go down. So the Fed is the number one. But number two, when you think about that, because the Fed is so data dependent, right? And you see this in the intraday volatility, almost every economic number is pushing, interest rates up or down fairly meaningfully. Now, recently, after the May 1st meeting, we had finally had interest rate volatility come down. As a matter of fact, the MOVE index is the lowest it's been since 2022. But then we had some a little bit stronger data. We had some, Fed speak that said, maybe a hike isn't necessarily off the table. And so a lot of that is still out there, but there's no question that the data, particularly that of inflation and the Fed path, is going to be the biggest driver of interest rates and the biggest driver of fixed income when you think about total return, particularly at levels that we're at today. Because spreads are so tight, and given the amount of spread compression that we've seen this year, it's really going to be those interest rates that's going to be the tailwind to total return, or possibly the headwind. We look at it as a tailwind because we have interest rates coming down at the end of the year, but spread compression is not going to be the driver of total return anymore. It's going to be carry and interest rates.
Right. Yeah, you've been talking with me quite a bit about your expectations for, let's say, the 10-year Treasury, lower than where it is today, which is around a 4.5. You're still looking about a 3.85, 3.9?
Oh, absolutely. I mean, listen, I think that, what we're seeing too, and we've had a little bit of mixed data. I mean, everyone talked about the strength of the Fed minutes, but those Fed minutes were before the unemployment, the CPI, the retail sales that were weak. So, we still think that the Fed is on course to cut twice this year, most likely in September. And so with that said, once the Fed starts, the market will, in our opinion, really start to move lower in terms of interest rates. And we also believe that both inflation and growth will be weaker, not weak, as we go into the second half of the year. So we expect it to trend lower. And I think that we're seeing part of this. Even with today's, revision of the GDP report, we're seeing a little bit of, not consumer weakening, but a little bit of consumer cautiousness into the marketplace. And I think that going forward, that's going to be a really big driver. Right now, it's going to be, whether or not inflation can stay on this favorable CPI report that we saw. Obviously, we have, CPI coming in the first 2 weeks of June. And then we have the June Fed meeting, which will have a new summary of economic projections. But I think the important point there, Anthony, is that the market is only pricing in one cut this year. So going into the meeting, the Fed has 75 basis points. If they move it to 2, great. If they move it to 1, the one cut, the market's pricing that in. What we don't want to see is for them to have a projected inflation that's much higher, which we're not anticipating, or for them to say we're not going to cut at all this year. Then you're going to have interest rates go up. Otherwise than that, you already have sort of a hawkish tone within what the market's pricing in for future Fed fund expectations.
Right. Has there been anything this year, or maybe in the last 8 to 10 months, that's been surprising about fixed income? Has there anything surprised you?
Yeah, listen, I am. There's two things that I'm surprised at. One is how well lower credit quality has done in terms of spread compression, right? And this is coming from a position where entering this year, we weren't in the recession camp. We were more in the soft landing camp. We weren't in the camp that, they were going to cut 150 basis points like the market expected entering this year. We thought we assumed they would cut much less, which we still do. But how well the lower credit quality is done as a higher correlation to the equity market, I think is surprising. The second thing that I think is surprising, which is a positive, is how much the capital markets, are open. I mean, the amount of supply that we're seeing in high yield and loans are almost at record. So you're seeing that capital markets sort of open again, which is great because the barrier to entries is a little bit lower, which of course helps financial conditions loosen. So that is a bit of a surprise heading into this year. I think part of the surprise, but not necessarily because we saw it in the first part of 2023 as well, is that increase in inflation and outside of this last CPI report that people weren't expecting, but that actually happened in the beginning of 2023 as well.
Right. As we said, inflation readings are not necessarily always going to go in one direction or the other. Sometimes there's movements, hiccups up and down. So, yeah, it's definitely surprising there, I think, for a lot of investors, including the two of us sitting here. Last thing, Leslie, look, as you said, we expect the Fed will cut twice this year, potentially starting in September. We also have an election on the horizon. So given that and some other things that you're keeping an eye on, what trends should fixed income investors be aware of, especially as we're kind of entering the summer months here?
Look, I happen to think, listen, volatility has fallen recently, but I think we're going to have just periods for just a little while longer volatility, but I do think volatility is going to decline in the second half of the year. We also think that, because the market is so compressed in terms of spreads, what this is really going to turn out to be is what we call that carry trade, right? So because spreads are so compressed, you're not going to get a total return because of more spread compression. You're going to get total return because of compounding income. And that's a second. So I think that's going to continue, but we want to do that in the higher quality sectors. And simply why we do want that in the high quality sectors is one, as I mentioned, the lower quality has surprisingly has tightened. And number two, because of where we are in the cycle, we like that a little bit more higher interest rate risk because we think, treasury yields come down. You're going to find that in higher quality. But even in the higher quality side, there's certain pockets that we're investing in simply because we like the carry and we like the interest rate component, like investment grade corporates, for example. I mean, those kinds of the spreads on there are 88 basis points. That's by not any means cheap historically, right? The cheaper asset classes are one that have had a very high correlation to interest rate volatility, right? And ones that we would consider short volatility products that have underperformed in the first part that we think will outperform in the second part of the year, particularly agency mortgage-backed securities. So when we think about how we want to position the second half, we want to have that higher quality. We want to compound that income. We want to take on that interest rate risk because, again, the fixed income market is a forward-looking market. The Fed is backward-looking. So when we start to see the slower economic data, which we believe that we will, even though we think it's going to be above trend, it's still going to be slower. And once that Fed starts to cut, which we also believe they will, you're really going to see those interest rates come down. And those type of products have a lot of price appreciation if you extend your interest rate risk a little bit more.
Leslie, thank you. Always love your insights. Great to have you joining us for this episode. Good to see you, Leslie.
Thank you.
Great. And for more information from Leslie and the rest of the Chief Investment Office, visit our Insights website at ubs.com/views. Plus, you can follow UBS on all the social media channels, including Instagram. You can follow UBS Studios there at UBS Trending. Lots of great content that you can find once you follow us. And if you have any questions about what Leslie and I spoke about today, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. Thank you all for joining us. See you next time, and don't forget to keep your eyes on what's trending.